Why your Social Security check is suddenly smaller. Many Americans are opening their bank accounts this month and asking the same troubling question. Why is my Social Security check lower? For millions of retirees, disabled workers, and widows, the answer is confusing and often shocking because what's reducing your check has nothing to do with a new law, nothing to do with a recent policy change, and nothing to do with mistakes by Social Security. Instead, your benefits are being reduced by a tax that has existed quietly for more than 40 years. And here's the most dangerous part. Most people don't realize they're paying it until tax season hits, or until their monthly check already feels tighter than expected. Many Americans were told that Social Security would not be taxed. Others heard promises from politicians claiming those taxes would be eliminated. But the reality is far different. If you receive Social Security and have any other income at all, wages from a part-time job, withdrawals from a retirement account, interest from savings, or even modest investment income, there is a strong chance that part of your Social Security is being taxed right now. This feels wrong to many people, and understandably so. You paid into the system your entire working life. Every paycheck, money was taken out automatically. You were told this was your earned benefit. So why are you being taxed again? To understand why your check is smaller than expected, we have to go back decades, long before today's inflation, housing costs, and medical expenses, and examine a system built for a very different economy. The tax you were never warned about. What makes this situation especially frustrating is that most people were never clearly warned that their Social Security benefits could be taxed in retirement. For decades, Americans were told a simple story. You work. You pay into Social Security. You retire. You collect what you earned. But hidden inside that system is a rule that quietly changes everything. If you receive Social Security and have any additional income at all, you may be subject to federal taxes on your benefits. That includes income from part-time work, retirement account withdrawals, interest, dividends, or even small side earnings. This is where many retirees feel blindsided. They didn't start earning more money to get rich. They started earning more money to survive. Rising rent, higher grocery bills, expensive prescriptions. Social Security alone often isn't enough. Yet the moment you supplement that income, the tax system steps in. And despite what many politicians have promised over the years, there is no blanket exemption protecting Social Security from taxation today. The rules have not changed. The tax is still there, and millions of people are paying it, often without realizing it until the damage is already done. This creates a painful contradiction. You paid Social Security taxes for decades through payroll deductions. Your employer paid into the system as well. And now when you finally rely on those benefits, the government takes another cut. To understand how this happened and why it keeps happening, we need to look at a decision made more than 40 years ago, during a time when retirement looked very different than it does today. The 1980s decision that still costs you today. To understand why Social Security benefits are taxed today, we have to go back more than 40 years to the early 1980s. At that time, Social Security was facing a serious funding crisis. The trust fund was under pressure, and lawmakers feared the system would not be able to pay full benefits in the future. Sound familiar? It should, because the same warning is being repeated today. In response, Congress created what became known as the Greenspan Commission, a bipartisan group tasked with saving Social Security from collapse. Their job was to stabilize the program without cutting benefits outright. They made several major changes. They gradually raised the full retirement age. They adjusted benefit formulas. And for the first time in history, they decided to tax Social Security benefits. The idea, at least on paper, was simple. Lawmakers argued that wealthy retirees, people with substantial income beyond Social Security, should pay taxes on a portion of their benefits. In 1984, they set income thresholds to define who counted as wealthy. For single filers, that threshold was $25,000. For married couples, it was $32,000. Back then, those numbers actually represented higher income retirees. The median household income in 1984 was around $22,000. These taxes were not aimed at average retirees trying to survive. They were meant to target a small group at the top. But here's the critical problem. Those income thresholds were never indexed to inflation. Not once. Not in 40 years. And that single decision is why millions of ordinary Americans are now paying a tax that was never meant for them. How frozen income limits quietly trap today's retirees. The real damage caused by Social Security taxes didn't happen overnight. It happened slowly, year by year, as inflation rose and income thresholds stayed frozen in time. Those limits set in 1984, $25,000 for single filers and $32,000 for married couples, made sense in a world where gas cost about $1 a gallon, homes sold for under $100,000, and healthcare expenses were a fraction of what they are today. But nothing else stayed the same. Rent climbed, food prices tripled, medical costs exploded, even minimum wage increased in many states. Yet the income limits that determine whether your Social Security gets taxed never moved at all. The result is a quiet but powerful shift. A tax that was designed to hit only wealthy retirees now hits ordinary working-class Americans, teachers who worked 30 years, factory workers with modest 401k savings, widows trying to survive on one income instead of two. These people aren't living lavishly. They're budgeting carefully. They're stretching checks. They're doing everything they were told to do. And still, they're being taxed. This is why so many retirees feel blindsided. They didn't suddenly become wealthy. The definition of wealth simply never adjusted to reality. Every year Congress chose not to update those thresholds, more people were quietly pulled into the tax net. And today, millions are paying a penalty that lawmakers never intended for them to face. Not because they failed, but because the system refused to evolve. Combined income, the formula that catches people off guard. This is the point where most people get lost, and where the biggest mistakes happen. Social Security taxes are not based on your total income the way many people assume. They are based on something called combined income, and misunderstanding this formula is one of the main reasons retirees are caught off guard every year. Here's how combined income actually works. First, take your adjusted gross income. That includes wages from a job, withdrawals from IRAs or 401ks, interest from savings accounts, and dividends from investments. Next, add any tax-exempt interest, such as income from municipal bonds. Then, and this is the part that surprises people, add half of your Social Security benefits. Not all of it, just half. But that half is enough to push millions of retirees over the line. Once that combined income number is calculated, the old thresholds come back into play. And remember, these numbers haven't changed since 1984. For single filers under $25,000, no federal tax on Social Security between $25,000 and $34,000. Up to 50% of benefits may be taxable over $34,000. Up to 85% of benefits may be taxable for married couples filing jointly under $32,000. No tax between $32,000 and $44,000. Up to 50% taxable over $44,000. Up to 85% taxable. Notice the phrase, up to. This is not a flat tax. The IRS uses a complex formula, which makes it even harder for people to predict the impact until it's too late. How a small raise can trigger a big tax hit. To really understand how Social Security taxes work, it helps to see how they affect real people in real situations. Let's walk through a simple example. Imagine a single retiree receiving $24,000 a year in Social Security. To make ends meet, they work part-time and earn $10,000 a year. When calculating combined income, only half of the Social Security benefit counts. So the math looks like this: $10,000 in wages, $12,000. Half of Social Security, just $22,000 in combined income. That person stays under the $25,000 threshold. No federal tax on Social Security. So far, so good. Now imagine nothing dramatic changes. No promotion, no new career, just a few extra work hours. That same retiree earns $16,000 instead of $10,000. Now the calculation becomes $16,000 in wages, $12,000, half of Social Security, $28,000 in combined income. Suddenly, they've crossed the threshold. Up to 50% of their Social Security benefits may now be taxable. That means a modest $6,000 increase in income can trigger taxes on $12,000 of benefits that were previously untaxed. Depending on tax brackets, that could result in $2,000 or more in additional taxes. This is what many experts call a poverty trap. You earn more money, but keep far less than expected. And this is happening to millions of retirees who are simply trying to stay financially afloat. The people hurt most by Social Security taxes. When you look closely at who pays Social Security taxes today, a troubling pattern emerges. The people hit hardest are not the wealthy. They are the ones trying hardest to stay afloat. Start with working retirees. Many Americans reach their late 60s and quickly realize that Social Security alone is not enough, so they take part-time jobs at grocery stores, hardware stores, or consulting in their old fields. They're not building wealth, they're covering bills, but that extra income often pushes them over the tax threshold, triggering taxes on their Social Security benefits. Then there are widows and widowers. When a spouse dies, one Social Security check disappears, but the mortgage, property taxes, and utilities remain. Many widows are forced back into the workforce or must draw from savings. That added income can suddenly make their remaining Social Security benefit taxable at the worst possible moment. Next are the people who saved responsibly. Workers who contributed to 401ks and IRAs are often shocked to learn that withdrawals from those accounts count as income for Social Security tax purposes. Planning ahead, doing what the system encouraged, can actually lead to higher taxes in retirement. Add to that disabled workers who try to work within allowed limits, and veterans who supplement benefits with part-time income. In every case, effort is punished. This is the cruel irony of the system. The people doing the right things are often the ones paying the highest price. The uncomfortable truth: these taxes help fund Social Security. As unfair as Social Security taxes feel, there's an uncomfortable truth that makes this issue far more complicated than it first appears. The money collected from taxing Social Security benefits does not simply disappear into the federal budget. It is sent back into the Social Security Trust Fund itself. In fact, in recent years, taxes on Social Security benefits have generated tens of billions of dollars annually. In 2024 alone, roughly $54 billion flowed back into the trust fund from retirees paying taxes on their own benefits. That represents about 10% of the program's total annual income. This creates a painful contradiction. On one hand, the tax feels like double taxation, and for many retirees, it absolutely is. You paid payroll taxes while working. Your employer paid payroll taxes too, and now you're being taxed again when you collect. On the other hand, eliminating this tax without replacing the revenue would make Social Security's financial crisis even worse. The trust fund is already projected to run out within the next decade. If that happens, benefits would be cut automatically by roughly 23% across the board. Removing tens of billions of dollars in annual revenue would only accelerate that timeline and deepen those cuts. This is why politicians often talk about eliminating Social Security taxes, but rarely follow through. The promise sounds good. The math does not. The real problem isn't that the tax exists. It's that the system was never updated to reflect modern realities, and retirees are now paying the price for decades of political inaction. When federal taxes aren't the end, state taxes make it worse for many retirees. The surprise doesn't stop with federal taxes. In some parts of the country, Social Security benefits are taxed twice, once by the federal government and again at the state level. As of now, 9 states still tax Social Security benefits in some form: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. If you live in one of these states, your retirement income may be hit from multiple directions at the same time. Federal taxes reduce your net benefit, and then state taxes take another bite, often without much warning. For seniors living on fixed income, this can feel overwhelming. You already paid payroll taxes during your working years. You may now be paying federal taxes on your benefits, and depending on where you live, you could be paying state taxes on that same income as well. That's why many retirees describe this as triple taxation. The impact is not evenly spread. Retirees with modest savings who rely on Social Security as their primary income source often feel the squeeze the most. A few $100s lost each month can be the difference between stability and stress. This also explains why location matters more than many people realize in retirement planning. 2 retirees with identical incomes can have very different outcomes simply based on which state they live in. One keeps more of their check, the other watches it shrink, and for those already considering a move in retirement, state-level taxation of Social Security has become an increasingly important factor, whether lawmakers acknowledge it or not. The 5-minute check that could cost you thousands. There is one critical step almost nobody takes, and skipping it can cost you thousands of dollars over your lifetime. After you file your taxes each year, there is something you are supposed to do that many Americans never even hear about. Check your Social Security earnings record. Your Social Security benefit is calculated using your highest 35 years of earnings. Every dollar you earned and paid payroll taxes on matters. But here's the problem. Those earnings are not always recorded correctly. Employers make mistakes. Social Security numbers get entered incorrectly. Companies go out of business. Records disappear. And when those errors happen, your future benefit can be permanently reduced. In the past, Social Security mailed paper statements every year showing your earnings history and estimated benefits. Congress ended that practice years ago to save money. Now the responsibility has shifted entirely to you. The only way to check is online through ssa.gov using a My Social Security account. This check takes about 5 minutes, but the stakes are enormous. Many people don't discover missing earnings until they apply for benefits in their 60s. By then, fixing the problem can be nearly impossible. Old employers are gone, pay stubs are lost, proof no longer exists. But if you check your earnings record every year, right after tax season, mistakes can be corrected while records are still available. This is one of the simplest protections you have, and one of the most overlooked. Practical ways to reduce Social Security taxes legally. Once people realize why their Social Security is being taxed, the next question is obvious. Is there anything I can do about it? The answer is yes, but it requires planning, awareness, and sometimes professional guidance. The first step is knowing your combined income number. Many retirees operate in the dark, unaware of how close they are to a tax threshold. When you're near the line, even a small change, like an extra withdrawal or a few more work hours, can trigger higher taxes. One commonly discussed strategy is Roth conversions. Withdrawals from traditional IRAs and 401ks count as income and can push you into Social Security taxation, but withdrawals from Roth IRAs do not. Gradually converting some retirement savings into a Roth over time and within reasonable tax brackets can reduce taxable income later in retirement. Another approach is timing withdrawals carefully. If you don't urgently need retirement account money, delaying withdrawals can help keep combined income below key thresholds. Once required minimum distributions begin, planning becomes even more important. Location also matters. If you live in a state that taxes Social Security and you have flexibility, relocating to a state that doesn't can significantly reduce your tax burden over time. This isn't right for everyone, but it's a factor worth considering. Finally, many retirees benefit from working with a tax professional or retirement-focused financial advisor. The system is complex, and small adjustments can produce meaningful savings. Why Congress hasn't fixed this, and what's at risk next? By now, a logical question comes up for many Americans. If this system is so outdated and unfair, why hasn't Congress fixed it? The answer is uncomfortable, but important. For more than 40 years, lawmakers have largely avoided meaningful reform of Social Security, not because the problems are unknown, but because fixing them requires politically difficult choices. Updating the tax thresholds for Social Security benefits would instantly reduce the tax burden on millions of retirees, but it would also reduce revenue flowing into the Social Security Trust Fund, money the system now depends on to stay solvent. Right now, Social Security faces a hard deadline. Within the next decade, the trust fund is projected to be depleted. When that happens, benefits won't disappear, but they will be cut automatically by roughly 23% across the board. That means retirees, disabled workers, and future beneficiaries would all receive smaller checks regardless of income. Politicians often talk about stolen Social Security money, but that framing is misleading. The funds weren't stolen. They were borrowed by the federal government and replaced with interest-bearing bonds. In fact, a portion of today's benefits is paid using that interest. The real issue isn't theft, it's decades of delay. Each year, Congress postpones reform, the math gets worse, and as pressure builds, the system increasingly leans on hidden mechanisms like taxing benefits to stay afloat. That leaves retirees paying the price for political inaction while the clock keeps ticking toward automatic cuts. The long-term reality. Planning in a system that won't be fixed soon. When you step back and look at the full picture, one thing becomes clear. This system is unlikely to be fixed anytime soon. For decades, Congress has delayed meaningful Social Security reform. Each year of inaction pushes the burden further onto retirees, disabled workers, and middle-income Americans who rely on these benefits to survive. That means individuals can no longer assume the system will correct itself. Taxes on Social Security benefits are not going away quietly. If anything, more people will be pulled into them over time as inflation continues and outdated income thresholds remain frozen. The longer reform is postponed, the wider the net becomes. This is why long-term planning matters more than ever. Understanding how your income interacts with Social Security rules allows you to make informed decisions, when to work, when to withdraw retirement savings, and how to structure income in a way that minimizes unnecessary tax exposure. It also means adjusting expectations. Many retirees grew up believing Social Security would provide stability and certainty. Today, it provides support, but with conditions, complexity, and increasing oversight. That shift requires adaptation, not blind trust. The most important takeaway is this: waiting for Congress to act is not a strategy. Knowledge is now your strongest protection. Planning is no longer optional, and small decisions made early can shape financial security for decades. In a system built on delay, those who prepare are the ones who suffer least. Final takeaway: what this means for your money and your future. After breaking down the facts, the formulas, and the history, one conclusion is unavoidable. Your Social Security check is not smaller because you failed. It's smaller because the system failed to keep up with reality. A tax created in the 1980s for a small group of wealthy retirees has quietly expanded into a burden carried by millions of ordinary Americans, not because they are rich, but because inflation rose while the rules stayed frozen in time. Today's retirees are working longer, saving more responsibly, and stretching every dollar, and yet they are penalized for earning extra income, punished for saving, and taxed again on benefits they already paid for over decades. At the same time, the government relies on this very tax to keep Social Security afloat, creating a system that is both unfair and financially dependent on that unfairness. That is the reality. Congress may eventually act, or it may continue delaying. But relying on political promises is not a plan. The people who protect themselves best are the ones who understand how the system actually works, not how it's marketed. Know your combined income. Check your earnings record every year. Plan withdrawals carefully. Get professional guidance when needed. Social Security is still a vital lifeline for millions, but it now comes with fine print. And in today's economy, understanding that fine print can be the difference between stability and struggle.